Hey veterans, my name is Steve Doherty. I'm the Raleigh VA loan guy. Today, I want to answer the question of whether you should refinance now that rates have dropped, we're in early September, or whether you should wait for rates to drop further. The answer will depend on whether or not you can save at least $3,000 in the first 12 months of refinancing. Today, I want to talk about whether or not you should refinance now, why it's important to save $3,000 in the first 12 months, given the fact that there could be an additional interest rate drop. I want to talk about a collateral benefit of refinancing, aside from reducing your monthly payment and reducing your interest expenditure. And we're going to look at some specific examples of refinancing, of why it does not pay to wait, and then also how much expected interest savings you can have by refinancing. Let's take a look. Before we get into today's topic, my name is Steve Doherty. I'm a loan officer in Raleigh, North Carolina. I am licensed to do mortgages in South Carolina, North Carolina, and Virginia. If you would like me to look at your mortgage and see if it makes sense for you to refinance now, please reach out to me. I will leave my contact information in the video description and in a pinned comment below. I look forward to hearing from you. Okay, so rates are down on Govy loans. They're around 5.5%, right? On a VA with a high balance, perfect credit. Conventional mortgages, we're at around 6.5%. So we've got a pretty good improvement. Rates are at about the lowest they've been since really for 24 months. Now, that may be short-lived. Today, we've lost a little bit. We're recording this on September 9th. We've lost a little bit of those gains that we've had over the previous week. But a refinance could still be in the cards. So the question is, given the fact that most people anticipate even more interest rate improvements over the next year or so, should you refinance now or should you hold out for a better interest rate? Well, the short answer is, if it makes sense for you to refinance now, you should go ahead and do it. You should not hold out for a bigger rate improvement. So you may be asking yourself, okay, well, what does that mean? When does it make sense? Okay, we're recording this on September 9th of 2025. So by the time you watch this video, rates could have changed dramatically, but the general question is still a good one, which is, when do you refinance, or when do you hold out for better rates if they are anticipated? So at this point, the general buzz is that rates will get better in the next 6 to 12 months. Keep in mind, we've been told that for about 2 years, right? This mythical rate cut is right around the corner. It's coming, right? Don't worry. So when do you actually move forward on that refinance? I think the conservative approach is to refinance as soon as it makes sense. When does it, quote unquote, make sense to refinance? It makes sense to refinance when you can recoup your closing costs within 1 year of refinancing. So let's break that down in a little bit more simple language. On a refinance, just like on a purchase transaction, you have closing costs. You also have prepaids and escrows. I do not consider those an expense of refinancing because you have taxes and insurance regardless of whether or not you refinance. But you will not have closing costs if you don't refinance, right? So that is really the cost of refinancing. You need to think of refinancing a mortgage like an investment. You are spending money to save money. And you need to ask yourself when you're going to get your return on that investment. When is that $3,000 that you're spending? When are you going to make that back as a result of lowered interest payments on the refinanced mortgage? If you can make that back within 12 months, it's a pretty safe bet. Even if rates do improve, let's say in 24 months, you could refinance again, right? But you're sort of asking a lot of the refinance at that point. You're asking it to pay you back within 12 months. And if you're thinking, well, I'm not actually spending money on a refinance, I don't have to bring any cash to the closing table, I want you to check out my video on this same exact topic, which is basically there's no such thing as a free lunch, how you will pay one way or another for your closing costs, prepaids, and escrows on a refinance. So you may be thinking, well, wait a minute, Steve, you didn't answer the question of what if rates get better? What if rates get better in 90 days? If you had just held out 90 days longer, you could have got a 3/8 lower interest rate and you would have achieved more savings. Here's what you have to keep in mind. As soon as you lock an interest rate on a refinance, you have guaranteed savings, assuming this is a good refinance done by a competent loan officer. Once you have guaranteed savings, you've saved money. What you're doing by delaying your refinance in hopes of an even lower interest rate is you're hoping for even more savings. So you haven't lost any money if you refinance prematurely. You just haven't saved as much as you could if you timed the refinance perfectly. But that's really part of the problem. How do you time a refinance perfectly? What if rates take a very long time to get lower? Every month that you are at a higher interest rate higher than you could have gotten a refinance, you are losing money. So at some point, yeah, maybe you do get to that lower interest rate, but if it takes you 14 months at a 1.5% higher interest rate, you haven't come out ahead. You've lost more money. So by waiting, you are gambling to save more money. Why do I use the word gambling? Because if it takes too long for rates to drop, or if they don't drop at all, then you are losing money. Refinancing as soon as you can recoup that $3,000, that is guaranteed savings. And if rates never drop, well, then you come out ahead. It's not that you lose if you refinance too early. You just don't gain as much if it ends up being a premature refinance. Let's take a look at an example to show how waiting, even if rates do drop further, might not be the best option. Okay, so here we have an example of motivated mortgage man who purchased a home in the summer of 2024. He made his first mortgage payment on August 1st of 2024. He had an initial loan balance of $500,000, and that was at an interest rate of 6.25 on a 30-year fixed. His balance is now $492,618. And we're going to compare that to two refinance scenarios. The first is a 5.5% that is available now with a starting loan balance of $504,000, assuming he's going to finance all closing costs, prepaids, and escrows and pay off outstanding interest. That interest rate is 5.5%, another 30-year fixed mortgage. And then a second refinance scenario that is 5.125, but it is not available for another 6 months, meaning for another 6 months, he will continue to make payments on that 6.25% interest rate, right? And the starting loan balance on that one is going to be a little bit less because he will have paid off some of the outstanding balance on the mortgage over those 6 months that he's waiting to refinance. Okay, so first we're going to look at what his total interest projection would be over the course of 12 months. So it's 1 year here on the refinanced mortgage at 5.5%. That would be $27,551. That's the total interest he will spend after refinancing in his first 12 months. Now we're going to look at 6 months at the current 6.25% interest rate. Now remember, he's already into that mortgage, right? And then what the first 6 payments would yield for interest payments on the refinanced 5.125. So why are we breaking it up into 6 months? Remember, he's going to continue on this current 6.25% interest rate for another 6 months before he refinances down to the 5.125, right? He's holding out, hoping that rates are going to drop. So if we add 15,354 to 12,810, we get a total interest expenditure of $28,164. So that means that the refinance now option at the end of a year, is actually $613 cheaper. So now let's tweak the scenario a little bit more and look at an 18-month scenario, about when the 5.125 starts to outperform the 5.5. So what we're going to do now is we're going to take the 15,354, the interest on the next 6 months at the 5.125, and then we're going to look at 1 year of interest at the 5.125, which is $25,528. So if we add the 15,354 to the 25,528, we get a total interest expenditure of $40,882. Let's compare that to 18 months
at the 5.5%. That comes out to $41,183. So at 18 months, the 5.125 is finally starting to outperform the 5.5, but only by $301. Now let's take a look if it takes him longer to get down to the 5.125 than 6 months. And let's say he doesn't get quite a 5.125, but rather a 5.25. Okay, so in this scenario, he is spending 9 months at the 6.25% as opposed to 6 months. So we're going to take the $22,994 that he is set to spend over the next 9 months on the current 6.25% interest rate and add it to the 5.25 for 3 months, right? So over the course of the next year, he's at 6.25 for 9 months and 5.25 for 3 months. So we're going to add this $6,573 to the $22,994 over the 9 months of the 6.25%. And that comes out to $29,567 over the course of 1 year. Now, again, let's go back and look at the 1 year of 5.5, $27,551. So if we subtract $27,551 from $29,567, we come to $2,016. So if it takes him 9 months to get down to 5.25, the 5.5 now will save him more than $2,000 over the waiting 9 months to get down to 5.5 or to get down to 5.25. Let's take a look at one more scenario. Okay, we're going to check in at the 24-month mark. Again, assuming it took him 9 months to get his lower interest rate of 5.25. So again, we're going to take this $22,994, the next 9 mortgage payments at 6.25, his current interest rate. And we're going to compare that to 1 year and 3 months, 15 months, or not compare it, but we're going to add it to the 15 months at the 5.25. So again, what are we doing here? 9 months, we're checking at 2 years, 9 months at 6.25, 15 months at 5.25 for a total of 24 months. So we're adding the $22,994 plus $32,635, right? That's the 15 months at the 5.25. And that gives us a total interest expenditure of $55,629. Again, going back to the 2-year mark on the 5.5 available now, that takes us to a total of $54,718, which means at the 2-year mark, the 5.5 now is saving him almost $1,000, $911, almost $1,000 compared to having to wait 9 months to get the 5.25.
And let's look a little bit closer on this whole when it makes sense, why the $3,000, why should that be the magic number that you hold out for? Well, generally speaking, I would say $3,000 is a pretty safe bet that would be your total closing costs on a refinance, right? Now you will have prepaids and escrows. We will collect those at closing, but again, it's not part of your refinance. So what you want to do is you want to calculate how much money you will spend in interest payments over the next 12 months on your current mortgage and compare that to how much interest you would save on the refinance mortgage at a lower interest rate. Whatever the difference is, that's your savings in 1 year. Those savings should add up to your total closing costs. Whether those are $2,500 or $3,600, it will be around that price tag. That's how much you need to save within 1 year. Now, in a different interest rate environment, you may not need that refinance to perform so quickly. In other words, you may not need that ROI within 12 months. For instance, during COVID, when we were looking at refinancing down to all-time low interest rates, and you were never ever getting back to that interest rate again, and this is an interest rate you might have for 30 years, then it wasn't as important for that payback to happen within 12 years because you weren't hedging against the risk of rates dropping again even further, right? You were getting the lowest interest rate possible and you were going to ride that for 30 years. Okay, so let's take a look at an example of a refinance and how the current interest payments compare to the projected interest payments on a refinanced mortgage.
So this is what refinancing will do to improve this borrower's cash flow and their interest expenditure. So we have two refinance scenarios. Both of these are presumably available now, right? We're just pretending. The one is at 5.5% and the other is at 5.25%. And we're refinancing at 6.25% mortgage. Again, that mortgage started with a balance of $500,000. He's been paying on it for a little over a year, and the current balance is $492,618. The reason these two mortgage balances are increasing on the refinance mortgage is because we're assuming that motivated mortgage man wants to finance all closing costs, prepaids, and escrows so he does not have to bring any cash to the closing table. Again, his current interest rate is 6.25. We have one proposed at 5.5% and another at 5.25%. So over on the right-hand side of the page, these graphs are showing his monthly payment reduction. This is just how much his monthly minimum payment will be reduced by virtue of refinancing. If he refinances now down to 5.5%, he'll save $216.93 per month. If he refinances down to 5.25%, he'll save almost $300, $295.48. While payment reduction is an important component of refinancing, it's not as important as interest expenditure reduction, right? That's the big savings. So over the course of 12 mortgage payments, if he refinances now down to 5.5%, he will save $3,059. If he's able to refinance down to 5.25%, he would save $4,319 in interest over the course of 12 months. This graph here, interest in 3 years, this is sort of the inverse of the savings over 12 months. It's just showing the total interest expenditure, and this time it's showing it over 3 years. So what this is saying, on the current mortgage, he is set to spend $90,579 over the next 36 months on his current mortgage at 6.25%. Compare that with only $81,481 on a 5.5% refinance and $77,705 at a 5.25% interest rate. So this means by refinancing now to 5.5%, he's going to save $9,098 over the course of 36 months at the 5.5, and he'll save $12,874 over the course of 36 months at the 5.25.
Okay, and so now that we've looked at how a refinance increases your loan balance, let's pay attention to the fact that you don't necessarily have to increase it by that much. Right? There's nothing that says you must finance all your closing costs, prepaids, and escrows. It's just the most common way of structuring a refinance because most people don't want to pay for something upfront if they don't have to, right? We love financing things. The other reason is that most people do not save for a refinance transaction like they save for a purchase transaction. So the thought of cutting a check for $8,000 or $12,000, depending on your insurance premium and your tax bill, that can be kind of daunting, right? That's sort of an ouch payment out of the blue. You get a call from a loan officer, great news, I can slash your interest rate. Only thing is I just need a check for $9,000. Most people aren't whipping out their checkbook and excitedly writing, parting with close to $10,000 out of the blue. So we tend to finance this. But keep in mind how a refinance impacts your mortgage stream. Just like on a purchase transaction, your first mortgage payment will be 2 calendar months after closing, unless we do an interest credit. But generally speaking, it'll be 2 calendar months after closing. That is not 60 days. That is 2 calendar months, right? So if you close on October 15th, your first mortgage payment will be December 1st. If you close on Halloween, October 31st, your first mortgage payment will be still December 1st, right? So it's 2 calendar months later. So you, depending on what time of the month you close in your refinance, you will skip 1 to 2 mortgage payments. Keep in mind, if you're paying escrows with your current bank, you will get whatever their escrow balance is back within 25 days of closing. Depending on the time of year, depending on whether or not you've paid your taxes for the year, right? If you're in September, October, your tax bill probably has not been paid. depending on when your insurance premium gets renewed, there could be a fair amount of money in that escrow account. So from a cash flow perspective, it could feel like skipping 2 to 3 mortgage payments. So if your cash flow is going to be improved that much by getting the escrow balance back, by skipping 1 to 2 mortgage payments, then you should be able to write a check for a portion of that money that has to be collected on the refinance. So a good way to kind of have your cake and eat it too, to maximize mortgage savings, right? By keeping the loan amount low, but also not disrupting your cash flow, is to write a check for the taxes and insurance, right? So you're not financing everything. Maybe you're writing a check for $5,000. But over the course of 60 days, by virtue of skipping 1 to 2 mortgage payments, plus getting a check for, let's say, $4,500 for taxes and insurance, you're going to be ahead of the game anyway. So this helps minimize your cash exposure, but also keeps the loan balance down to maximize your monthly mortgage interest savings. But you don't have to do this, right? There's no right or wrong way to structure a refinance in terms of how you're going to pay for the closing costs, prepaids, and escrows. If short-term cash flow is a priority for you over long-term mortgage interest savings, you can finance everything, skip 1 to 2 mortgage payments, get that escrow balance back, and that's going to be a really nice injection to your cash flow, especially in the fall, kind of heading into the holiday season. If you're saving $7,000 over the course of 3 months, that's going to feel good. And it's not necessarily the wrong thing to do. It just depends on what your priority is: short-term cash flow improvement or maximizing mortgage interest savings. And this is really the big collateral benefit to refinancing a mortgage. It kind of gives you a little pause on your biggest monthly expense. I know groceries are really expensive now, and now that's a competing expense to your housing payment. But skipping 1 to 2 mortgage payments and getting the escrow balance back, that can be a really nice improvement to your cash flow. And that's another benefit of refinancing a mortgage, apart from just saving mortgage interest. So in summary, we've learned that it may not make sense to wait to refinance. Locking now, while it makes sense, and it makes sense if you can recoup your closing costs within 12 months, if it makes sense to refinance now, that's actually the safer approach. Waiting for rates to drop even further can be risky, especially if the ultimate rate improvement is either a modest one or takes a long time to happen. Again, thank you so much for watching. My name is Steve Doherty. I'm a loan officer in Raleigh, North Carolina. I'm also a United States Marine Corps veteran. I am licensed to do mortgages in South Carolina, Virginia, and North Carolina. If you would like me to tell you whether I think it's worth it or not for you to refinance, I'm more than happy to do the analysis and all that math for you. If you would like to do that, I will leave my contact information in the video description and in a pinned comment below. Thank you so much for watching. I look forward to hearing from you.